Hello and welcome. Sometimes the market tells a story so clear it's almost unbelievable. And today, February 26, 2026, was one of those days. The Asian markets felt like they were on two completely different planets. So let's jump right in and unpack this massive divergence. Just look at these numbers. Seriously, this says it all. On one hand, you've got South Korea's Kospi absolutely flying, up over 3.5%. And on the other, Hong Kong's tech index getting hammered, down almost 3%. Now, that's not just a little gap. That's a chasm. It's a great decoupling, and we're about to figure out exactly why it happened. So here's how we're going to break it down. We'll start with the two very different paths the markets took today. Then we'll dive into why Korea is doing so well and what's holding China back. After that, we'll look at some quantitative forecasts for March, explore a really interesting strategy from our source material, and wrap it all up with the big picture takeaway. All right, let's get into our deep dive. What we saw today wasn't just some random one-off event. Oh no, this is the result of a huge paradigm shift. It feels like the fundamental wiring of capital in Asia is being completely redrawn right before our eyes. To really get a sense of what's going on in Korea, you have to look at this number, 6,307. That's where the Kospi closed today. But what is absolutely wild is that this is part of a 46% surge just since the start of this year. That makes it the best performing market in the G20, and not just by a little bit, but by a mile. This isn't just a rally, it is a full-blown explosion. So, what's the fuel in this rocket? What's powering this incredible surge? Well, the source material points to three really powerful ideas that help explain what's happening. And it all starts with a concept from a German professor named Günter Dück. Okay, so the first piece of our puzzle is this new hunting grounds theory. Günter Dück basically argues that for huge companies to keep growing, they can't just keep selling the same old stuff in the same old places. They have to break out of what he calls the pork cycle, these overcrowded, saturated markets, and find completely new, innovative territories to conquer. And bam! This perfectly explains what Korea's done. They found the ultimate new hunting ground, the global AI semiconductor value chain. I mean, when NVIDIA drops a mind-blowing $68 billion quarterly revenue number, it's like setting out a feast for Korean tech giants. Samsung Electronics just smashed through the $1 trillion market cap, and SK Hynix is tightening its grip on the next generation of must-have memory, HBM4. They didn't just find the hunting ground, they practically own it. The second key idea comes from economist Saifuddin Ammous, and it's called low time preference. Now, it sounds complex, but it's really simple. It's about having the discipline to sacrifice a little bit of comfort today for a massive payoff tomorrow through long-term investment. And that's exactly what Korea did. For years, they poured huge amounts of capital into developing future tech like HBM4 memory. And now they're reaping their rewards with record-smashing profits. It's harvest time, and the harvest is huge. Now for the third and maybe the most important piece of the puzzle. This one comes from Nobel laureate Simon Johnson. His theory is all about institutional economics. He says that a country's wealth really takes off when its rules of the game change from being extractive, where they benefit a few insiders, to being inclusive, where they protect everyone, especially the investors putting their money on the line. And guess what? Korea is doing this right now. They've actually changed their commercial laws, forcing companies to cancel their repurchased shares. This is a huge shift away from just benefiting majority owners and toward protecting all shareholders. And this isn't just some feel-good policy. The data shows that these kinds of moves can slash market volatility and attract a flood of new investment. Okay, so that's the story of Korea's rise. But now we have to flip the coin and look at the other side. While Korea is leaning into new tech and better rules, the Chinese and Hong Kong markets are wrestling with a completely different set of problems. And we're bringing back Saifuddin Ammous here because his ideas are crucial to understanding this side too. The source material argues that the nearly 3% drop in Hong Kong's tech index is a direct symptom of what he calls price distortion. Essentially, in a centrally planned economy, the market's natural signals get all mixed up and confusing. So how does that play out in the real world? Well, you have government policies called anti-involution that are meant to stop the rat race of hypercompetition. But investors are looking at these and thinking, wait, does this just mean you're going to put a ceiling on how much money companies can make? Then you have NVIDIA coming out and explicitly leaving China out of its future revenue forecast. That sent a shockwave through the market, signaling a very real and widening tech gap. You put those two things together, and you get what's called an information cascade. Basically a tidal wave of fear that leads to everyone running for the exits, especially in Hong Kong. All right, so we've dug into the why behind this epic split we saw today. Now for the fun part. Let's look ahead. What are the quant models from our source material telling us to expect for the month of March? This is it, right? The question on everyone's mind. After a day like this, where are we headed next? Well, the models are pointing to some pretty specific targets. Let's walk through this. For the Kospi, the target is actually a range between 7,500 and 8,000. That's based on the idea that the market is fundamentally revaluing giants like Samsung. Now for Hong Kong, the models are actually predicting a bit of a technical bounce. They're saying the HSI and HS Tech inching up a little, mostly because everyone's expecting some kind of stimulus announcement at the big 2 sessions political meeting coming up. So you've got this forecast, continued strength in Korea, but a lot of uncertainty elsewhere. Given that, the source material lays out this really fascinating quantitative strategy. It's designed for exactly this kind of high-risk, high-reward environment we're in. The strategy has this great name, the aesthetics of boredom. And just to be super clear, we're just explaining the model from the report here. This isn't any kind of direct advice. But the whole idea is to find a way to navigate these wild swings in the AI sector a bit more safely. And the core concept is right here in this quote: add a mathematical shock absorber to a high-risk portfolio. It's a cool idea that actually builds on Simon Johnson's work, the idea of using stable, predictable assets to balance out your high-growth but also high-risk investments. So here's how the model works in 3 steps. First, you're long on the big Korean semiconductor leaders, but you use a technical signal like the RSI to buy when they have a temporary dip. Second, you short the Hong Kong tech stocks that are most in the crosshairs of regulations and geopolitics. And third, and this is the most important part, risk management. You watch the VIX, which is often called the market's fear index. If you see the VIX starting to rise at the same time that prices are rising, that's a classic warning sign that things might be getting overheated, and it could be time to think about taking some profits off the table. So, after going through all that, what's the big picture? What's the one thing you should really take away from all this? Let's tie it all together. This chart right here really says it all. You have 2 paths, and they're moving in opposite directions. On one path, you have Korea, which is all about strengthening shareholder rights and dominating a crucial new technology. And on the other path, you have China, dealing with the challenges of central planning and geopolitical risk. And you can literally see capital flowing from one path to the other. And that leaves us with this final, really powerful question. The 2026 market isn't just about stocks going up and down. It's a battleground of different systems, different ideas. And the central question is this: where is capital going to go? The answer seems to be, it will flow to the countries that respect their shareholders and lead in the technologies that matter. And based on what we saw today, the market has made its choice pretty darn clear. Thanks for watching.